Okay, in this next set of videos, we're going to have a look at a lot of our macroeconomic objectives. So what we're trying to achieve at a macro level, or what are some of Australia's goals as a whole, or any economy's goal as a whole. So we're going to, first few videos are going to be looking at how we measure economic growth and what's meant by economic growth. Then we're going to look at equity, unemployment, inflation. And finally, we're going to just discuss the budget and also the impact that the coronavirus has had on the budget and our level of debt recently. So as we talked about in the first video, microeconomics is looking at individual markets, factors that impact decision-making within individual industries, whereas macroeconomics is looking at aggregate output and looking at things like total level of income, total level of production, total level of debt for Australia, how much prices are increasing and things like that. So essentially, there's 5 key goals for an economy, and we're going to discuss these sort of throughout the next few videos. So we want to keep unemployment low, we want economic growth to be strong, we want to achieve relatively equitable distribution of income, so it's fair between citizens, not equal, because we don't want communism, but an equitable distribution of income. Low inflation, which means we want to keep prices relatively low, not growing too fast, and also sustainable debt levels, so the government and also the household sector are not going into too much debt. So just some important terms, we did touch on these in other videos, but just to clarify, gross domestic product is the first one. Basically what that means is the total production within an economy over a period of time. So it's within Australia's borders. It's all the production of goods and services that occurred within Australia. The word final market value basically just means like we calculate the end price that things are sold for, but we'll talk about that a little bit more another time. But basically, gross domestic product at this point in time, think of it as the total production of goods and services that occurred within Australia's borders over a period of time. GDP per capita is income per person. So we take the total production or total income for a country, then we divide it by the amount of people in that country to give you an idea of the GDP per capita. The aim of an economy is to maximise society's living standards. So to do that, they need to use their resources as efficiently as possible to maximise income per person. A country's material living standards is measured by income per person. So if you look at this sort of sheet here, you can see here, this measures the sort of the quarterly growth every year. So what that's saying, or every quarter, sorry. What that's saying is between June and September, production increased by 0.3%. Between March and June, production increased by 0.6%. June to September, 0.4%. For the year, production increased by 1.7%. So if our GDP grows by 1.7%, that means that the total value of production is 1.7% higher than the year before. And that's the main measure we use for a country's performance. GDP per capita is measuring what the income per person has increased by. So if you notice here, GDP has increased by more than GDP per capita. And basically what that means is that the income per person has grown slower than the overall income. And the reason for that is that our population also grows. So even if the total production increases, income per person will only grow if production grows faster than population. So if you look at this quarter here, production's increased by 0.2%, but income per person's actually gone down by 0.2%. And what that means is that the population must have grown at a faster rate than production grew, so we've actually got less per person. So it's all well and good to have GDP growing, but it's really important we also increase GDP per capita or income per person. So in terms of measuring economic activity, basically you can measure economic activity by sort of 3 measures. It can be measured by the total production, so the total production in an economy, the total income generated by all the citizens within that country, so all the salaries and wages and profits they generate, or, and this one's the hardest, the total expenditure on Australian-made goods and services. So not total expenditure by Australians, because that includes imports, and that's not going to generate growth for our economy. Total expenditure on Australian-made goods and services is what we're looking at. The total expenditure on Australian-made goods and services, which includes exports, so spending by people overseas on Australian products, but doesn't include imports, which is spending by Australians on overseas products. They're the 3 ways we measure economic activity. If we look at this point here, actually I'll skip that, we'll talk about that in class. Economic growth occurs when there's an increase in the real volume of goods and services from one year to the next, and we'll talk about what this real means in a second. But basically, there's an increase in production of goods and services. Australia aims to grow in real terms at about 3 to 4% per year. So our aim is to grow around 3 to 4%. Anything lower than that, the argument is that because our population grows at around 2%, it can also, weak growth can lead to less income per person. But if we grow too fast, and especially if this growth is caused by more demand, it can lead to excessive inflation. It can also lead to environmental problems because the faster we grow, it can often lead to more carbon emissions, more cutting down of forests. It can also lead to excessive debt if we're borrowing money to try and stimulate spending. So essentially, we aim for around 3 to 4% per year, not too fast, not too slow. So if you look at this, the business cycle, basically a country's growth moves in like a wave-like pattern. So that green line represents the sort of wave-like pattern that countries will move through from periods where growth is really fast in peaks. Generally, inflation's quite high during those periods as well, to periods where growth is quite weak, called troughs, and then expansions and contractions occur in between. So expansions when economic growth increases, contractions when economic growth starts to slow down. You can look at this graph here, you can see this is just a hypothetical situation, but one thing that's important to recognize is that growth is positive whenever growth is above 0%. So even if you look at this point here, where most people say, well, growth going down, it's not going down, it's positive, it's just slower than the year before. What we mean by that is if growth here is at 4%, growth here might be at, say, 2%. It's not till we're below this line that growth is actually negative or that we're in a recession. So a recession would be 2 quarters or 6 months of negative economic growth. That only occurs when we're below that 0% line for more than 6 months. When the line's trending downwards, that just means that growth is not as fast as the year before. It's only in this period, even when here, it still means that growth is below 0%. So that might mean that growth was negative 2%, now it's negative 1%. If we're below the 0% line, growth is negative. Above, positive. So this is Australia's business cycle in recent times. As you can see, is this graph cuts out at 1%, and the blue line never goes below 1. Which is indicative of the fact that economic growth has been positive in Australia from 2006 all the way up to 2020. This year is the first year we're likely to experience negative economic growth. Now, in some of these periods when growth is weak, like here and here, income per person may have been going down, but this is looking at total production. Total production was still increasing. And there was a range of reasons that caused this. This one was caused by the GFC, which we talked about in previous videos. This is over the last 25 years, and you can see our last recession, so now you've got the zero there. The only time we've experienced growth of below 0% for more than 6 months was around 1990, 1991. So we've had nearly 29 years of uninterrupted positive economic growth, but given the recent problems, that's likely to stop in 2020. In fact, it's pretty much, it's a sure thing that we're going to experience our first recession at some point this year, despite the government's best efforts. So this is China's business cycle. As you can see, the 6%, it never actually goes below 6%, but China has an ability to grow a lot faster than Australia without causing inflation. And there's a range of reasons for that, including the fact that they're able to grow their ability to supply faster than Australia. So they invest heavily in education and infrastructure and technology, which means supply can meet demand, so they don't experience excessive inflation. But they've been growing above 6% now for the last over 10 years. So in terms of measuring economic growth, and we'll start this in this video and then finish it in the next one, there's 2 measures of economic growth, real GDP and nominal GDP. So basically economic growth occurs, as we said, when there's an increase in the real value of production, and when the increase in real value of production is greater than population growth, then income per person increases. Basically, there's 2 measures of GDP, real GDP and nominal GDP. I'll discuss this quickly now, and then we'll talk about how to calculate both in the next video. So real GDP means an increase in economic growth after removing the effects of inflation. What we want to see is whether we've actually produced more, and the value of production may increase because you've produced more, but it may also increase because prices have gone up. So we want to remove the impact that higher prices have had to make sure that production has increased because of the GDP has increased because of increased production. So real GDP is the main measure of living standards. That's the one we focus on. That's the big one because it removes the effects of inflation. I'll show you how to do that in a second. Nominal GDP is a figure that has not been adjusted for inflation. So it uses current prices, and it's very rarely used by the government because essentially production may just increase, a value of production may just increase because things are more expensive. We don't want that. We want to see whether we've actually produced more. So we use real GDP. We'll talk about that in the next video.